I want to talk to you about how to pay yourself within an S corporation and how to do it properly. How do you do it properly, right? So here's an overview I want you to pay attention to. Before I actually get into the nitty gritty of paying yourself, let's quickly go back to 101, S corporation 101. So what is an S corporation? An S corporation is a corporation with a specific tax setup. So unlike a sole proprietorship or partnership where you are personally liable for business debts, an S corporation is a legally separate entity from its owner. So S Corps provide you with a layer of protection for your personal assets in the event that your business cannot pay its debts, or let's say your business is sued, right? So while partnerships and LLCs, in other words, limited liability companies, require certain owners and partners to pay self-employment taxes, an S corporation does not, and this is a biggie. And I'll explain a little on why is that a biggie. And so instead, employees of S corporations have employment taxes withheld from their paychecks. And one of the primary benefits of an S corporation is tax savings. Okay, with a C corporation, profits are reported on the company's tax return and then again on shareholders' tax returns as dividends. So this means what? It means we're talking about double taxation. Profits are taxed twice. However, an S corporation doesn't pay federal corporate taxes. Instead, it passes its profits or losses onto the shareholders to file on their personal tax returns. So when you file your 1040, you actually will file income or loss that you got from the S Corp. So how many shareholders can S Corporation have? Up to 100 shareholders, and all must be United States citizens or permanent residents. Each of these shareholders can receive distributions for their share of the company's profit free from payroll taxes, as long as they are receiving a reasonable salary for their work at the company. And if a shareholder is not performing work for the company, they will not be an employee and instead will receive a K1, Schedule K1 for passive income, okay? And there is no minimum salary for S corporation shareholder employees. Basically, the IRS, the agency uses a formula called reasonable compensation, okay? And so because you pay yourself a wage as an employee of your company when you are an S corporation, you might technically be eligible for unemployment benefits when your salary drops or disappears unexpectedly. By the way, boss, welcome back to the show. Make yourself comfortable. In today's conversation, I'll explain to you how to pay yourself within an S corporation. So let's get into the nitty gritty here. So what is the approach? Let's talk about S corporation distributions versus salary. For tax purposes, you can elect S corporation tax treatment to keep your taxes simple and claim the profits on your personal tax return instead of paying corporate taxes. So in accounting speak, you earn money two ways when you own a business: distributions and salary. So distributions are what? Are the profits and losses that pass through the S corporation to you as an owner, shareholder. Distributions are not your employee wages and they're not treated as self-employment income. So that's for distributions. You also have salary. So salary is the money you pay yourself as an employee of the S corporation, your employee wages or reasonable compensation. So it's important to really understand that because the IRS, as I said before, plays an emphasis on that word reasonable. So a reasonable salary is a must. The IRS requires S corporation shareholder employees to receive a reasonable employee salary, which the agency generally defines at least what other businesses pay for similar services. So evading taxes by disguising your salary as a distribution could get you serious penalties on top of a big back tax bill if an IRS audit recharacterizes your S corporation income as salary. You don't want that. You never want to go there, okay? So you could actually pay tax penalties of up to 100% plus negligence penalties. You never want to go there, okay? And I don't care which tax attorney, the best tax attorney possible in town, he or she is not going to get you out of that trouble. So what is reasonable salary for an S corporation? Well, it's up to you to decide how much employee salary to pay yourself versus how much to take as distributions, which might sound exciting, except that you have to make sure it jives with the IRS rules, okay? So here are some of the factors the IRS considers to determine whether you are paying yourself an S corporation reasonable salary. So think about the training and experience, the duties and responsibilities, the time and effort committed to the business, the dividend history, payments to non-shareholder employees, timing and manner of paying bonuses to key people, what comparable businesses pay for similar services, compensation agreements, use of a formula to determine compensation. Remember, the IRS has a database of compensation across the country, so it knows how much similarly situated people or professionals are being paid. Boss, I want to quickly remind you of today's topic. We are having a conversation about how to pay yourself within an S corporation. So besides the fact that you need to really pay attention to a reasonable conversation, let me give you a few salary stats so you are clear about what you do. So the thing is, if you're not sure how much you want to pay yourself, you want to base your pay on industry stats to land on something comparable to what others are being paid, right? So you can actually find out about employee pay through the BLS, so the Bureau of Labor Statistics. This is the Department of this is actually an agency within the Department of Labor, so this is pretty official. You can also go through employee review sites like Glassdoor, Salary, and Pay Scale. So those are pretty reputable platforms that give you, let's say, employee compensation information by company, position, industry, and location. This is really good. Now, what if you wear multiple hats? Like you listen to me right now, you are like, you know what? I do everything in my S Corp. Well, small business owners usually perform multiple jobs, and the IRS knows that because the IRS knows a lot needs to get done to keep a business running every single day. So basically, these jobs, the way you pay yourself, again, going back to what I said earlier, it has to be reasonable. The IRS is not going to pay attention to the nitty gritty and say, you know what? Oh yeah, you're paying yourself like no. It has to be just average. So, for instance, if folks in your industry are being paid $75,000 a year, like in a similar situation, in a similar capacity, if you're paying yourself 65, 70, 80, this is not really that bad, okay? And you are able to make adjustments to figure out your local salary depending on things like inflation or things like how the business itself is doing. Because the thing is, you can't pay yourself if the S corporation is not generating revenue. Because the bottom line here is that you are taking money from the business, and the business must actually generate revenue. If it's not generating revenue, then you need to adjust your salary to a downward inclination. So what I'm trying to say here is that when you pay yourself, make sure it is reasonable, but also make sure that whatever you pay yourself, whatever reasonable amount you pay yourself, is in sync with how much performance your business is generating in terms of revenue. Really, really important. Now, let me give you a winner here. So I want to share with you ways to pay yourself as an S corporation. First of all, if you own an S corporation, you basically have several ways to pay yourself. The first one is salary. So you work at your company, and if you work in a company as an employee, you need to receive compensation that allows you to pay employment taxes to the IRS. So this is actually a requirement regardless of other forms of compensation that you receive as a shareholder, such as distributions. And such compensation is traditionally paid as a salary so that employment taxes are properly reported. And the IRS requires S corporation employees to be paid reasonable compensation, as I said. And so for S corporation, this means you must ensure that you are paid compensation that is not so low as to avoid paying required taxes, and it is comparable to the salary of officers with your experience at similar businesses. So the first way to pay yourself is through salary. The second way here is through distributions. When does it make sense? Well, if you own a business but are not involved in day-to-day operations, you might want to go through distributions. If you own an S corporation that's profitable and has more than enough cash to cover future expenses, it's also possible to receive compensation by taking distributions. These are payments of earnings to shareholders, usually in the form of cash or stock. So this is kind of cool because it allows you to actually have financial flexibility. If you're not active in your company's operation and you do not provide services to the S Corp, you can receive compensation as distributions rather than a salary. The primary difference here between a salary and distributions is that distributions are not subject to employment taxes. However, they are considered part of a shareholder's personal income for tax purposes, which means what? It means that you are able to, you don't pay taxes at the company level, but you are paying taxes at the personal level. So those distributions that you're getting from the S corporation, you're going to have to report them in your Schedule C on your Form 1040. Okay. And one thing I need to say is that these distributions are tax-free until they exceed a shareholder's stock basis. So beyond that point, they are taxable. The stock basis is the shareholder's initial investments in the business, which may be decreased by certain business losses or increased through business income. By the way, boss, I want to quickly remind you of today's topic. We are having a conversation about S corporation, how to pay yourself. So the first way is through salary. The second way is through distributions. The third way is actually a combo of those two. In other words, you actually have what we call a hybrid strategy here. So you pay yourself through salary and distributions. And this actually might make sense in certain scenarios. Let me explain. Let's say you work at your company and you want part of your compensation to be based on the business's performance. And if you are an owner and shareholder employee, you can also take distributions in addition to your salary when the business is doing fantastically well. Such distributions are not subject to employment taxes as long as your salary meets what I just told you about, the reasonable compensation standard, right? However, if that standard is not met, the IRS can reclassify other compensation as taxable income. And you know that you never want to go there because of the penalties, of the fines and everything, okay? And so before choosing the option of the hybrid option, salary and distribution, it's always a great idea, in our view, to consult with an accountant or let's say a tax lawyer to understand the requirements of reasonable compensation. Okay. Let me give you a few pro tips before we actually continue the conversation here. You need to decide how to pay yourself from an S corporation. Now, keep these points in mind when deciding how much to pay yourself from your S corporation. Your total employee compensation includes salary and bonuses, as well as health benefits listed as wages on your W-2. Not paying yourself any salary while your business earns money is a big red flag for an IRS audit. Translation, do not expect to get away with it. And minimum wage requirements are totally different from an S corporation reasonable salary requirements. So what I'm trying to say here is that if you operate, for example, in a professional field, paying yourself minimum wage likely will not make the cut at tax time because the IRS will look at it as a big ass red flag. So the bottom line is you can always call the IRS if you are you're not really sure. The IRS is most likely to audit you if you're taking shareholder distributions without a salary. Let me give you a few steps here so you have a clear idea what we're talking about. How do you make S corporation salary payments to yourself? So once you actually organize your business as a legal entity, like an LLC or S corporation, paying yourself gets more complicated than just collecting money from clients or customers. You need to operate like a business with employees, even if you're the only one on the payroll. In other words, if you're a single member LLC or a single member S corporation, you still need to have a complete foundation for your payroll. So a few things to keep in mind when you actually set up, let's say your S corporation for payroll. First of all, your company pays half of your payroll taxes, that's 7.65% from its own funds, withholds the other half, 7.65% from your pay, and sends the entire amount to the IRS as a tax payment. That's number one. Number two, your company sends a W-2 form to the IRS each year, showing how much you were paid. It also files an annual employment tax return. Number three, your company has to pay unemployment taxes on your behalf. So the federal unemployment tax, the FUTA, is 6% of your first $7,000 in pay, and your state might require you to pay state unemployment taxes too. The fourth thing is your company might have to provide workers' compensation coverage depending on your state requirements. And the last thing here is that your company might have to pay a state disability insurance, so SDI payroll taxes in some states, including California and New Jersey. and one operated corporations can opt out of SDI in California. Now, the thing is that you need to understand when you set up the payroll for your S corporation, you got to pay attention to S corporation salary frequency and S corporation payroll services. Like if you pay yourself once a month, you're not going to need payroll services the same way you would if you are paying yourself once a week, right? So it's up to you to determine how often to pay yourself an employee's salary. It might be once a month, once a week, once or twice a month. It really depends on you, okay? And if you ever need more money, you can take a shareholder distribution at any time. That can be a simpler and more efficient, a more tax efficient way to boost your income periodically, because you will not withhold taxes on distributions. And pulling money this way is simpler than constantly changing your employee's salary and actually recalculating payroll taxes and employment tax every time. So you do have options, and you can also reach out to certain payroll services like Gusto, or OnPay, for instance, for more help. Let me give you a bonus here. So when we talk about S corporation, how do you pay yourself? It's important to report your S corporation salary on your taxes. So just like any other employee would, you have to report your salary on your taxes. Your payroll provider compiles a W-2 form by January 31st each year, which actually shows you your total employee wages for the previous year. And so you have to report that amount as income on your Form 1040 when filing your tax return for the year. Your W-2 does not include your distribution income from the company. So what about reporting S corporation shareholder distributions? Well, instead of W-2, your S corporation files IRS Form 1120S, U.S. income tax return for an S corporation, to report your distributions. And so this form is actually an information return that reports your business's income, deductions, profits, losses, and tax credits for the year. It also includes a Schedule K-1 for each shareholder. What I'm trying to say here is that when we talk about Schedule K-1, we're basically sending some kind of memo to the IRS about the tax payments, the payments and withdrawals that are happening in the company. Because what the IRS will do is the IRS will actually reconcile the info that it is actually receiving from the company. In other words, the S corporation, and the information it is receiving from the individual taxpayer. So it is a great way for the agency to see that people are complying with their tax obligations. Okay, remember that you need to report your share of the business's net profit or loss from your Schedule K-1 on your Form 1040 when filing your tax return for the year, and this happens on Schedule C. And so if everything I'm telling you is a little complicated, it's just a lot better to have a tax pro complete your company's Form 1120S and Schedule K-1s to ensure accuracy. Okay. Remember that you are paying taxes on distributions also. This is a little confusing because you do not withhold payroll taxes, but you will in fact still owe federal income tax on your distribution. And if the total income tax you owe on self-employment income is $500 or more, you cannot wait until April 15th to pay all of it at once. You as a taxpayer need to make estimated quarterly tax payments, and this is your responsibility. Thank you so much for your attention. I really appreciate it. And I just want to quickly recap to this conversation. So I explained to you S corporation, how to pay yourself. So I give you the overview, the approach, the winner, our pro tips, the steps you need to follow, and the bonus. Thank you so much. God bless you. I'll see you next time. But until then, remember, stay marvelous.